If I could have everyone's attention, please. Could I get your attention, please? Ladies and gentlemen, please join me in welcoming our webcast viewers. My name is Jillian Riley, and I'm honored to be the president of the Canadian Club of Toronto. As you know, our club does a great job of providing a forum for business, political, and cultural leaders to share their ideas with us. In developing our programs and events, we strive to not only ensure we have a diversity of perspectives, but also of our speakers. Today's panel is no exception. I would also like to recognize the youth and young leaders who have joined us today from the Rotman School of Business. If you could please stand and we can acknowledge you. It's always wonderful to have you in attendance. Thank you. Now let me introduce our panel. Volatility. That's the word on the lips of market analysts, financial advisors, and business investors everywhere. Recent stock market fluctuations and instability have triggered memories of the market crash of a decade ago. Is this cause for concern? What do we as Canadians need to do to overcome our own jitters and remain confident in our investment decisions? We're very delighted to have a panel of experts who are ready to address and discuss these issues with us today. Joining us are Jean Boivin. Dr. Boivin is the Managing Director and Head of Economic and Markets Research at the BlackRock Investment Institute. Prior to joining BlackRock, he served as Deputy Governor of the Bank of Canada and then Associate Deputy Finance Minister. So Jean, we're delighted to have you today, and thank you so much for being here.
Thank you for having me.
Jean-François Perrault. Mr. Perrault joined Scotiabank just over 2 years ago as Senior Vice President and Chief Economist. Prior to joining the bank, he held prominent roles with the federal government, the Bank of Canada, the IMF, and the World Bank. Jean-François, thank you so much for being here as well. Kim Shannon. Ms. Shannon founded Siona in 2002 and serves as President and Co-Chief Investment Officer. The well-respected and multi-award-winning entrepreneur has 35 years of industry experience. She has served as Chief Investment Officer and Senior Vice President at Merrill Lynch Investment Canada. Kim, thank you so much for being here today.
Terrific, thanks.
And finally, Howard Green will be our moderator for today. Mr. Green has spent more than 3 decades as a broadcast journalist and a founding anchor at BNN. He's also a best-selling author who is currently working on his 3rd book. And he talked about this book at lunch, and it all sounds very fascinating. It's a biography of legendary railroad CEO, the late Hunter Harrison. So we'll all look forward to reading that, Howard. So thank you all for being here. This is going to be a great panel. Hopefully it's not all doom and gloom. I think there are some positives to discuss. Please don't forget to use the cards on your table because we really do want to encourage an interactive discussion. That's what makes these events so exciting. Mr. Green, I'll turn over the podium to you. Thank you.
Thank you so much. Thank you, Jillian, for those generous introductions, and thank you to all of you for coming today, and thanks to the Canadian Club of Toronto for organizing this and having us, and great to have you 3 panelists with us today. You know, as Jillian alluded to, we had a roller coaster at the beginning of the month. Everybody's been getting a bit of vertigo, I guess, and we've had a snapback. Everybody wants to know what to do with their money. Over the last 9 years, we've had virtually 0 interest rates, little inflation, asset reflation. So now what? You know, assuming that we're not day traders in the room, although some of you may be, but let's frame it a little bit differently. The last 9 years were X. What's Y going to be, Jean, the next 9?
So Yeah, I think it was interesting. First of all, thanks for having me. I'm delighted to be back in Toronto and to be at the Canadian Club. I thought it was interesting the way we've started the discussion, talking about volatility picking up, reference to the crisis, and whether we might be seeing, hopefully it won't be all doom and gloom. I think what makes this circumstances we're seeing now very difficult to read through is that this is a very unusual cycle. And we have a tendency to look like in time frame and think about 9 years, and you've talked about 9 years of zero interest rates. I think this has been a very slow recovery, and we're just getting now to the part of the expansion where eventually we're going to get late cycle in this global recovery, but we're just barely starting that part of the late cycle.
You don't think we're in the late cycle, or you think we're just starting it?
I think we're starting to see some overeating, but you haven't seen, like, the U.S. economy has just barely started to operate at potential. After all of these years, we've been slowly trying to get back to potential. Now we're back at potential. There is... I'll come back maybe later to that. There's even questions about whether we're really at potential. And typically, once we reach potential, the economy will operate for some time with some overeating, but we're not seeing much overeating now. And at that speed, I think the time to the next peak is measured in years, not in quarters.
So you're a bull?
I think to get to that point, we need to think about how much of that is being priced in the market already. And I think there is already a lot of that story that is reflected in equities, risk asset, and so on. But we got a big news over the last 2 months. We can debate whether from a public policy perspective it's desirable, but we are getting a huge stimulus in the U.S.
With the tax cut.
With the tax cut, I think it's boosting earnings. We're seeing earnings surprise like we haven't seen in a very long time, and I think that's creating momentum for the risk asset over the next year and maybe more. So from a near-term perspective, we are constructive on equities in general and risk asset.
Still buy equities, still buy U.S. equities. You're nodding.
Actually, my strategist colleague at BlackRock upgraded last week our view on U.S. equities from neutral to overweight. So, yes, buying.
Okay, Kim, I'm thinking maybe you have a different opinion.
That's what makes for a really great debate. And
right,
I think that's
and you can disagree.
The differences of opinion here. I think we're in the 18th year of a sideways market. That's a very volatile period. But overlaying all of that, for the United States, we're the second most expensive market in 120 years on a valuation perspective. And the most predictive equity valuation is the Shiller PE multiple. And again, that's in its second most high PE multiple in financial market history. Exceeded only by, and we just recently popped right through the 1929 stock market high, exceeded only by 2000. And 2000 was an outrageously overpriced market. So if we're going to use that as a comfort blanket about the security of the equity market, it's a bit of a thin lining of blanket. And so we think that, you have to be careful in this market. This market is not a market to try and make excess returns and take risk. I think this is a market about capital preservation and surviving, and being very careful about how you lay down your bets and to play the game incredibly defensively. Because in the long run, equities are an excellent returning asset class and a great place to be. But
couldn't you, sorry to interrupt, couldn't you have said essentially the same thing a couple of years ago? I mean, this has been a 9-year bull, and you could have missed out on a lot of stuff if you'd pulled back, say, 2-3 years ago.
And that's why we don't say go zero weight. We don't think anybody should attempt to market time markets. I think that investors should be incredibly well diversified at all times and then trade a little bit around the edges. But we're suggesting to investors, for us, we're a niche equity manager, and we have to be fully invested all the time. So how do you play in a risky market like this? You avoid excessive levels of financial risk. You look for very consistent earnings. You look for dividend growth. You look for quality of management, and try and hide in the weeds.
Do you pay much attention to macro? Because you're a bottom-up intrinsic value manager. Do you pay much attention to macro, or is it noise to you?
It's largely noise. And the Bank Credit Analyst, a great think tank here in Canada, has highlighted that looking at 112 years, I think something like 18 different markets, and they said if you could perfectly forecast the economy, it only explains 17% of stock market behavior. So it's explanatory, but just, it takes a lot of different factors to value a market over the long run, and you should never try and value the market in the short run. And this market is a pricey market, and so caution should be used. And actions like we saw earlier in the month were vulnerable for people. People have run into risk assets, and they might get spooked. There's a quote from over 100 years ago for English investors, because we were in a very similar period over 100 years ago. And it said John Bull, which in England meant the everyday man investor. John Bull can stand for anything, but he can't stomach a 2% return. And what he was trying to tell us, and that the story is stuck throughout history, is that when returns are incredibly low, like they are today, investors go chase better returns, which means they usually go into brand new esoteric asset classes that are unproven.
Like shorting the VIX.
Yes, in hope that maybe it could get them better than 2, so they can, achieve their financial dreams.
JF, you get to break the tie. I know you don't make equity calls, but you get to break the tie. You're a macro guy, so, them's fighting words from here. They used to say on Bugs Bunny.
So, I look at it from a couple of perspectives. One is, I agree largely with Jean that the U.S. and Canada, for that matter, are just, you can debate as to whether or not we're in excess capacity or not. And to the extent that that is linked to the length of the cycle, I think there's reason to argue for both countries that we've got, at least a couple of years left before you run into significant challenges from a macro perspective. So I think from that perspective, the macro fundamentals are good. And to think of the market correction or sustained market correction in a world in which, say, in the U.S., where growth is accelerating relative to a world in which growth is decelerating, because we're clearly in an accelerating phase in the U.S., I think that provides a very significant degree of comfort to firms and investors on the potential for profits in the economy. So, PE ratios are extremely high and they look scary, and you can think about those as an indicator of risk and an indicator of reversal in markets. Or you can think about them, which is how we think about them a little bit more on the economic side, as an indicator of future activity, kind of a real-time check on how confident folks are about the state of the economy. And if you'd applied that last year and thought about equity market performance in 2017 and looked at PE indicators then, as you pointed out, Howard, you would have thought the market's overbought, that there's, if anything, the risks are on the downside. Whereas in fact, one interpretation was markets were telling you that growth is probably going to be stronger than you think it is, and that largely played out last year. Certainly in the Canadian space, we think it's going to play out in the U.S. space this year as well. Another thing to think about, which gets to your longer term issue, is, and this is something that's very different from history. It's related to like a really big picture macro issue, which is global savings and investment balances. So there is a tremendous amount of excess savings in the global economy. We've seen that play out in the bond market very, very clearly.
What does that mean in plain speak? What does that mean for interest rates, for instance?
Well, it means that interest is lower than otherwise would be, because because essentially you got a large pool of savings pursuing a limited pool of assets. So that means that folks have a greater tolerance for risk, say, in the bond market than they used to. It means that what we consider to be bubble-like conditions in the bond market this year, last year, whenever it was, any years of the last 5 or 6 years, that in fact maybe there's something deeper at play, which is that folks need to invest, and they're looking for any kind of investment vehicle. So you're seeing that. We've certainly seen that in the bond markets. You're seeing that in how folks start to think about infrastructure financing now. You got pension funds all over the world chasing that kind of stuff.
Sounds like a gross distortion, that at some point, when you squeeze the toothpaste tube, it goes shooting out somewhere else.
Well, there's that potential. but it reflects kind of these deep structural parameters of the global economy. You got like the Asian economies, which are high savers, which are increasingly important parts of the world, against the U.S., which is actively dissaving. But so you have this overlay of a flood of money looking for sources of return that is much bigger now in proportion to the size of financial markets, the size of the global economy, than it was at any point in history, basically. So that provides, in a way, a lot of cushion to downside by virtue of the fact, or it makes it difficult to extrapolate from historical experience what's likely to happen in the future, because you've got this very different behavior on the part of households, essentially, and firms.
Well, Jean, pick up on that, because you were with the Bank of Canada, for a few years. You swam in this a lot. So what about this excess savings, and what's it going to do to interest rates? Because that's what everybody's watching, particularly with Powell. Is this guy going to be a hawk to try to prove himself? And if he is, and rates rise more quickly than we think, stocks go down.
So I think, to loop back and anchor that in the discussion we're having here, which I think is great, I think the starting point matters a huge amount for how we think about what's next. And I think the starting point is ambiguous. I was with my senior PM portfolio managers colleagues. We have these twice a year event where we debate the outlook. And the question that I posed was, if you had to characterize in one word what the market environment is right now, is it exuberance or cautiousness? And the room was split evenly. It was 48-52.
Fear or greed?
But that's pretty telling, that you have the people see this environment and they see it as exuberant, like chasing for yield, and after many years of a bull market, where at the same time there's a lot of very good case to say that we're in an environment where there's a lot of fears, cautiousness, which is reflected in the fact that our clients keep talking about the fact that they're sitting on cash, they're not necessarily allocating to risk asset, they're trying to wait for the next dip to do something, and so there is a positioning that is reflecting cautiousness, and I think this is where Jean-François is referring to. It's reflecting globally in the fact that people are sitting on a huge amount of savings, much more than we've seen historically. 22 trillion is the amount of savings in 2018 that will be generated. And that reflects, still the scars of the recession we've seen. And I think there's still this. So we have to be cautious. I think being constructive on equities has to be seen in the starting point matters. And I think the starting point is a bit cautious, at least for some part, a big part of the client. I think rates will be. Sorry.
Go ahead.
No, I don't. You're the chair.
Okay, I'm going to speed things up here, but I just have to ask a naughty question. You're the BlackRock guy. How can BlackRock not be constructive on equities? If BlackRock were not constructive on equities, there wouldn't be an equity market.
Is that right? Is that right? We change our positions on equities, and on we're underweight fixed income, and there's still a very healthy bond market going on right now.
But you're $6 trillion in assets last time I checked. Something what?
We're six a bit more, which is in a various type of product. So no, I think we have different kind of products. We have indexing products, which actually these discussions don't directly matter. We have fixed income credit. So I think we operate the space. But so I think there's we'll see, and we happen to be, by the way. If you think about the 5-year outlook, we think that the valuations will be a drag on returns for equities. So from a slightly longer horizon, we're in a low return environment, and it won't continue the way we've seen it. So, but at the same time, I think that right now there's a near-term kind of story that is not inconsistent with being cautious.
So, Kim, to you on the cash question, Warren Buffett's letter on the weekend, $116 billion in cash at Berkshire. Michael Sabia, the case a week or two ago, cash. How much cash do you have? How much cash do you think people should set aside percentage-wise in their portfolios now?
Our job is to be fully invested. So we're 3 to 5% cash, and we don't have a compelling, unlike 2007, 2008, we felt that there was a compelling reason to have a lot of cash and asked our clients to have that. We haven't gotten to that point in this market, because I will agree with both the Jeans here that the fundamentals in the short term look excellent. We have like a synchronicity in the marketplace of a global economy, 70% or more. That's good for the economy. The problem is that in the short term, the market is mostly noise and fundamentals don't matter.
But
in the long run, the 10 years, and that's where we're all agreeing as well, 5, 10 years, you put more time in, the market starts to take the fundamentals into question. And the long-term fundamentals is that John Bull has pushed up the value of risk assets. It's the everything bull market. And most commentators are sitting back and saying, what's a bargain? Where can I hide?
But if it's the everything bull market, I'm going to quote Buffett again from his letter, the light can at any time go from green to red without pausing at yellow. So how do you know when you need cash if it can go from green to red like that? Like if there's an unknown, to quote Donald Rumsfeld, who knows what North Korea does, whatever.
And an active manager, unlike a passive manager, can build a more resilient portfolio. And historically, we've always seen active managers in aggregate do well in frothy, rich markets like we have today. This is very much, this market is so full of hype. This is reminding me of the hype of 2000. In fact, we now have hype on e-commerce again. Do you remember Grocery Gateway? I know you're seeing the trucks in Toronto these days because Longo's bought the name, but Grocery Gateway, which was a hot new IPO, bricks and mortar stock were going to die 18 years ago because we were all going to be buying, online. Well, total sales for online today is 8.5%. It's growing, but it's not dominating the whole space. And Grocery Gateway went bankrupt. So I think this market with Bitcoin and cannabis stocks and artificial intelligence, and robotics, there's so much hype going on in the market. This is John Bull chasing hopes and dreams. And maybe you're right. Maybe they should have cash. But we're building a resilient portfolio. We don't need the cash per se to be defensive overall.
So, JF, back to you. Because you laid out a scenario, and you guys are in the analysis and prediction business, essentially, and prediction's a scary business to be in. I don't remember many people who predicted the drop in oil prices in 2014, for instance. So, what do you worry about when you write your reports, do your analysis, make your predictions, and what's your own perception bias that you have to watch out for?
Well, I'd say the thing that we worry about the most now, we're having a hardest time wrapping our heads around, is the intersection of strong growth in the U.S. with the trade objectives of the Trump administration. And I say that because we're in a world where the Trump administration has made very, very clear they don't like trade deficits. But they also very much like fiscal deficits. And given the fact that the U.S. consumes usually more than it spends, you have a situation where the current account deficit in the U.S. is going to rise very significantly this year. The trade deficit is going to rise very significantly this year. The fiscal deficit is rising very significantly this year, which means that the U.S. government is going to rely on foreign sources of financing to a very large degree, as it always has. And as the Trump administration is confronted with this reality, which is trade is going in the opposite direction of what they wanted to, you're seeing increasing signs of a protectionist response, which might lead to trade wars at some point in time. But, and this is the part that we're trying to figure out, it also means that the U.S. in a way has become far more reliant on China than it thinks it does, than it thinks it has in terms of Chinese financing the U.S. fiscal deficit.
And what's the risk there? Because that's been going on a long time.
Well, it's been going on a long time, but the U.S. has never kind of attacked China. So what we see now is an administration in the U.S. that is actively considering measures on the trade policy side that would harm Chinese economic interests. And it's easy, or I guess the administration is not taking into account very explicitly if it is, The Chinese have a very, very, very strong ability to retaliate in ways which are incredibly damaging to the U.S., which is, essentially start to sell a bit of treasuries. And to the extent that that happens, if it does happen, and this is pure conjecture at this point in time, but it's just a risk that we're mindful of, given the rhetoric, that if we end up in this world where the trade deficit, the fiscal deficit start to have these unanticipated consequences of leading to higher, you'd think they'd lead to higher interest rates normally, but triggered by a foreign power messing with the U.S. financial system because somebody's messing with them. That to me is it's something that I think we're not paying enough attention to.
So that's not priced in anywhere?
Well, it gets to some of the folks that talk about holding cash because of risks and volatility, and but I think the extent to which trade policy and the reliance on foreign financing intersect in the U.S. is something that's dramatically underappreciated as a risk, given how belligerent both sides can be on this issue. It's not like the U.S. is going to deal with Canada where, we're going to be upset and we'll slap tariffs on them and maybe, resolve. The Chinese can go in and just sell, $100 billion worth of treasuries in a day and sink the market and just completely change market dynamics, or do the same thing on equity markets.
Is that built into the bank's stress test?
No.
There's news. Any reporters tweet?
Well, we stress test on a range of outcomes, of course.
Okay, so we have a few minutes left for the panel, and then we'll come to some of your questions here. And I'm going to ask a double-barreled one of each of you here to finish up. I'd like you to tell people the best way to protect their capital, but also to make a call. And you can make a call on any asset, any stock, any global market, any currency, any rate, a yard sale, whatever you want to do. So, Jean, I'll start with you. Protecting capital and make a call.
And what horizon are we talking about? Just to.
Well, why don't we go with? We won't go with the day trader horizon. Why don't we go with the 9-year horizon that we started with?
9-year horizon. So I think. I think the best way to protect your capital is not to stay on the sideline, especially if we're talking about the 9-year horizon. I think, as I said, this cycle has a lot more to run. We will get to a point where it's going to be turning at some point. But one thing that we haven't touched explicitly about is the massive amount of liquidity that is in the system. And that colors a bit how we should be thinking about PE ratios and multiples. That could be the explanation for why they look the way they are. But in any case, I think the best way to protect your capital is to stay invested. I think over that kind of horizon, equity, a good allocation to equity is a good way to protect. And at the same time, there are significant risks on the geopolitics that will not be priced in until they are materialized. And a good allocation to fixed income as a ballast to these manifesting these risks is a good way to build a portfolio or to protect the picture. In terms of the call, I would not make a call for 9 years. That's other than generic.
What's one you're comfortable? What's one you're comfortable?
But the one we're comfortable. One is I think there's a normalization of policy that is going on. Policy divergence is reemerging. I think. Given the fiscal stimulus we're seeing in the U.S. and so on, there's going to be a faster tightening of monetary policy in the U.S. than what the market is currently appreciating. I think Powell is going to be a gradual guy and chairman, but still, I think his signal, and I think there's a logic to do 4 rather than 3 hikes this year.
So is that harder for passive investors then, if markets go down, and better for active investors like Kim?
I don't think that I was not driving at this kind of conclusion. I think all of these decisions are active anyway. It depends on the kind of product you decide to implement. But my point I was trying to drive at is I think the call I would make is the rates in the U.S. Short-term rates are likely to be higher than are currently priced in. And in Europe, I think it's the opposite. So that's my highest conviction call for the term.
Kim?
My favorite short right now would be an ICO, an initial coin offering of any sort. One of the most hyped areas of the marketplace, I think that would be a good bet. And you had two questions.
Yeah. Protect your capital and the call. But just on the call, the short of the ICO. Are you short Bitcoin or anything like that?
No. We don't do those things. But we're long only. But
Okay.
that would be my bet if I had to.
Yeah. Okay. And protecting capital.
I think I mentioned that a bit earlier.
Diversification.
So be very broadly diversified, avoid a financial risk yourself personally, but also in the companies you're investing. And I mentioned a bunch of things, quality and dividend growth and consistency of earnings.
There is a risk, though, in intrinsic value investing, like in every form of investing, right? It was tough for folks like yourself for a long time because you got smacked by the macro headwinds, even though they looked like they were, cheap stocks, right?
Yeah, we've had value investing has been tough for the last decade. But if you look, Famine and French did the study, and over 80, right back to the beginning of the century virtually, and 86% of the time, value outperforms. And a few times it underperforms like we have now, so it's a great opportunity to buy value now. It's relatively inexpensive and underappreciated in our opinion.
So JF, you can wrap it up on protecting capital and making a call for us.
Well, protecting capital, I don't think I have any better things to say than what John Kim just said. On the call, maybe bring you back to Canada for a sec. I think as we think about the monetary policy tightening process in Canada, markets are significantly underestimating the risk of higher interest rates in 2019. So we tend to think about, what the bank's going to do in the next year or so. We listen to what the governor says. So markets have got, 2.5 interest rate increases priced in. We're in a world where we think there could be 5. So we think substantially more monetary policy tightening than people think at present.
Okay, we're going to open it up to you folks now. I've got a few cards here, and I'll go to the first one. If, and then brackets, when the housing market corrects significantly, what impact will that have on equity markets? If any. Who'd like to jump in on that one? Is there a spillover, like a wealth effect impact? I think that's the essence of that question. Maybe Jean.
And we're talking about Canada, I presume, here.
Yeah.
So I mean, it depends a bit on how that scenario, if and when, would play out. I think the baseline is, this is a burden that's going to continue to weigh on Canadian growth. Now, luckily, I think there's offset that are coming globally that helps to manage that. But if it were to intensify, you have falling house prices that's going to be affecting one side of the balance sheet of our Canadian household, and that's going to be, I think overall reducing growth, reducing consumption, and that. Difficult to tell a story where this is good news for equities. So that's kind of the obvious kind of answer. I think the question that is more we need to manage or Canadians will be managing is how abrupt this is, or if it's just like a longer slug.
Anyone else want to jump in on that?
I agree with Jean's comments, and I think that at least inside the market, you can look at certain sectors that are likely to be impacted, which you alluded to, which is the consumer products will be impacted if the consumer was being financially challenged. And the banks are not fully exposed because we do have CMHC, but they do have exposure and credit card exposure, so the banks might feel some credit losses there. So that's an area to be underweight in this current environment in anticipation of that potentially occurring.
Anything on that, Shannon?
Yeah, I just add quickly. We don't think there's going to be a housing market correction in Canada. Start off with that. But if there were to be, the main consideration that we would have at this point in time is there is a sense internationally. I think international investors are easily spooked with respect to the Canadian housing market, that there's a sense that the Canadian housing market works like it does in the US or other parts of the world where there have been corrections. And it doesn't. It's far more resilient. That being said, if there were indications that we were entering a significant housing market correction, I think the extent to which foreign investors are concerned about the resiliency of sectors associated with the housing sector in Canada, I think you'd likely see a significant pullback of that kind of funding, and those would be the firms that are essentially lending in the real estate side. So, a bit of a repeat of home capital, possibly with much broader implications, just by virtue of the fact that it's likely to be amplified by a bit of ignorance about how our markets work relative to other parts of the world.
Let's go to this one. Please discuss the role that key indicators play in your assessment of future market returns. Example, sentiment, valuation, yields, and other. Actually, let's talk a little bit about sentiment on that specifically, because, Jean, you brought that up with regard to the 50-50 on exuberance versus caution. I mean, we had a real, tug of war there recently, between FOMO, fear of missing out, and fear, and back to FOMO again. So who'd like to field that one?
Well, I mean, I can start. So in terms of indicators, I mean, there's not one indicator we look at in particular. Really, even though one could argue as to whether macro is important or not in terms of a determinative of yields in the short run or returns in the short run, it's difficult. We really try to think about markets in the context of the broader macroeconomy. So, GDP, inflation, that kind of stuff, and the link to interest rates. As we've been talking about, the evidence that we have suggests that we really are in a period of exceptionally strong growth globally, and synchronized or not, depending on how you want to define synchronicity. But and that, to my mind, is a much more powerful indicator of market sentiment than any particular indicator that pops up on the radar screen in Canada or the U.S. We are in this period of, we underestimate the strength that is provided by the fact that all advanced economies are growing in essentially extremely rapid paces of growth. And that has implications that I think are just a little bit broader than looking at any one particular indicator in any one particular country.
Either of you?
You want to
Yeah.
I'll make two comments on this. One is more directly on the indicators, and I think when we look at tracking the near-term evolution and what matters in the evolution of our thinking, we track a whole bunch of indicators, but there's one thing in particular that is turned out to be pretty insightful in our view is tools that we have to do text mining and big data kind of analysis to track the sentiment of corporates. So one thing we do is text mine the CFO and CEO earning calls, the transcript, and tease out from that, what we think are objective measures of the true sentiment of these corporates and the likelihood that they would deploy capex or business investment more generally on the back of that.
Like the adjectives they use?
So actually, there's an interesting thing, which is like the tense of the verb they use turns out to be very, very informative. If they tend to use more the present tense, it's a good news because they focus on what's happening now, and if they tend to emphasize the future, sometimes because things are not so well right now, and things will be better. And the ratio of these tense that you see on average in the earning calls tends to be a very good indicator, back testing of what's going to happen. And what's interesting right now is we've got a fiscal, I'm a little obsessed on this fiscal story in the U.S., but I think it's a significant story. And on that front, what we've seen is, these indicators have been more or less flat over the last few months, and suddenly over the last couple of weeks they started to pick up, and this is coming from the specific signals that is about these kinds of capex investment intention, so in line with some sentiment that is building up. The broader point I was about to make is, it's not about the indicator, but what we think is like one of the biggest things to track right now about whether equities would turn out to be overvalued and might be a shift in sentiment is what happens to the potential growth of the global economy. And I think we've been going through a few years of a long cycle where we've been more and more pessimistic about the ability of the economy to grow with aging population and so on. We might be at a point where now there's upside risk to potential growth. I think this could be very meaningful because that changes the inflation picture materially, changes what central bank will do if it gets to be upgraded, but also we would be in a different rate environment. So I think that has a huge implication across asset class.
I think in equities, the single most important indicator historically is to look at the Shiller PE multiple. And it's the price you're paying when you enter an investment. So you buy a cheap market, a low PE multiple, you're going to get a good return. You buy the most expensive PE multiple in the market, you're going to get a very modest return. And in the US right now, the Shiller PE multiple, history is telling us that the expected 10-year average annualized return today is 0. And after 2000, it told us that 10 years later we'd get 1. And what did the US get 10 years later? 1 in terms of a capital gain. So we've got a very modest return expected in the US in a 10-year time horizon annualized. Fortunately for us Canadian investors is we're in a bit better position here because we're not as expensive. And so we're sitting in an expected return more along the lines of 3 to 5%. And so that's an optimistic scenario for Canadian investors going forward.
Okay. Here's one, I'm not sure, maybe this is for you, JF. What role does the pressure from the liability side of most funds, i.e. pension insurance, play in the next few years?
That's a good question. Why do I get it?
Anybody else?
Well, I mean, I think you've seen that, sorry, 2 seconds. I think you've seen the impacts of that already, which is on the pension fund side, part of the search for yield are large pension funds. That's a pretty obvious thing. So, to the extent that the low rate environment contributes to challenges on the pension fund side, search for yield, the diversification of assets, that all is expected to continue. I mean, in our world. We don't think there's scope for U.S. Treasuries to go much above 3%. Now, they're almost there now, so we could be surprised on the upside there. But there isn't a world in which, what's that?
Next week.
Next week, yeah. But, from that industry's perspective, we're not in a world where we think you're going back to 6 or 7% returns on fixed income. I mean, that may be the case. I think it'd be a temporary fluke. But it comes back to potential, it comes back to inflation, it comes back to demographics, it comes back to savings and investment balances. And all those things suggest to us that we're in a low rate environment for quite a long time. Might bounce around that a little bit, but not going back to where we were.
Let me go to another one, and maybe I can throw this to you, Jean. What do you feel would be the impact of interest rate hikes on private equity markets and the continued robust valuations paid because of the use of leverage, short and long term?
So first, just to maybe piggyback on where Jean-François left it, we do think that rates are normalizing, but it's an environment where rates will remain low compared to what we've seen historically. And the story there is, people will get tired of repeating the same thing, but there is like a massive saving globally, and that is keeping a lid on interest rate. So in that context, I think there's been a search for yield across asset class that has been kind of, catalyzed or has been pushed by this low rate environment. As we normalize rates, you would expect that to start to move somewhat in reverse. And, all the alternative space of investment, infrastructure, private markets have been kind of, beneficiaries of this push. So you would think that this is going to be somewhat moving in the other direction, but I think we're still in a low rate environment. Returns will still be meager across asset class, and that's going to make, I think, overall, the alternative space continue to be an attractive place to go in. We see our clients continuing to be allocating in that direction from a medium-term perspective.
Kim, one last one to you, and then I think we have to call it. What about Canada? Home country bias versus home country advantage?
There's a lot of comments about home country bias, and of course bias is a negative word. So right off the bat, it's sort of a negative. And you get an argument that, you Canadians have too much invested in Canada you should really diversify more, and that your market is so cyclical due to the exposure to materials and financials that your market must be riskier and it must be lower returning. And in actual fact, you got to go out there and look at the data, and you look at the long-term SCI World data compared against other major regions, and Canada gets the same long-term returns, which by definition you would expect, and no materially greater levels of risk. And all markets are idiosyncratic. Most markets have the top 3 sectors representing between 60 and 80%. And Canada is in the upper end of that range, but we're all pretty, even the US is, the top 3 sectors are typically 60% of the overall market. But the home country advantages that you get is, you get tax advantages in your own home country. You get lower fees for depositing, transfer costs. You get your natural asset liability matching. I'm going to put it rudely, most investors in Canada are going to live and die in Canada. They don't have to deal with currency hedging. And currency hedging can be extraordinarily expensive from time to time. And so those advantages, plus the fact that our market gets a normal return to almost any other region in the world, that you're not disadvantaged by having a big exposure to the domestic market. And so it's okay, you can do that. And in the US, they just sort of sit behind the MSCI World benchmark that says, go ahead, own 58% of the US, it's fine, because that's what's in the global benchmark for now. We know those move around a lot.
All right, we're going to call it there, but it's been great having the 3 of you with us. Jean, Kim, and JF, thanks so much.
Thanks.
Thank you.
Thank you. Thank you, Ollie.
I'm just going to do a quick thank you. On behalf of the Canadian Club of Toronto, Jean, Kim, JF, you were terrific. You did not disappoint. I learned a lot of new acronyms tonight, things that I'd never heard before. Exuberance or cautiousness, everything bull market. Learned about John Bull, didn't know about him before. FOMO or fear. So there's lots of new things to take away. I'm not sure we'd answered the question, volatility, versus optimism, and there seems to be a lot of differing views. But having information and knowledge is very helpful, and I think all of us go back with a little more information and feel a little bit more knowledgeable, and your insights were very helpful and useful. So thank you. Now to Howard as a moderator, you never disappoint. We do look forward to seeing your book. You ask very thoughtful and important questions. So thank you to each and every one of you.
Thank you.
Now, I very quickly am going to mention some upcoming events. Just on the back of this one, we have Bill Morneau for breakfast tomorrow on March 1st. He will be here at the Royal York. On March 2nd, we have a dynamic panel which will address the Century Initiative, the bold vision for Canada's growth and prosperity in 2100. So looking ahead. To order your tickets or to learn more about the club, please visit us at our website, canadianclub.org. You can also join the conversation via Twitter and Instagram by following us at CDNCLUBTO or by using that hashtag. We would also like to thank MediaEvents.ca, Canada's online event space, and VVC for live streaming today's event. Thank you so much for being with us today. We really appreciate it. We really hope you'll come back again soon. We have a lot of great speakers. Thank you.